Welcome to our series on basic trading concepts. Today, we're exploring market cycles. Understanding the cyclical nature of markets is crucial for investors and traders, as it helps in making informed decisions based on the market's predictable patterns of behavior. Market cycles are patterns or trends in the market that occur over time. These cycles, driven by a variety of economic factors, investor psychology, and external events, typically include phases of growth, peak, contraction, and trough. The growth phase, often called an expansion phase, is characterized by rising market prices, increased investor confidence, and strong economic indicators like GDP growth and employment. Businesses thrive, and new investments flood in, fueling the upward trend. For example, the period during the tech boom of the late 1990s was a classic growth phase, marked by high investor optimism and rapidly increasing stock valuations. Next comes the peak phase. Here, the market hits its highest point. Growth slows down, valuations may become overstretched, and investors start to become cautious, often leading to increased volatility. An example can be seen in the peak of the dot-com bubble, where after a period of rapid growth, the market reached unsustainable levels, leading to caution among investors. The contraction phase is marked by a decline in market prices. Economic indicators weaken, investor sentiment turns negative, and there's a decrease in overall market activity. This phase can be accelerated by external shocks or natural economic slowdowns. The 2008 financial crisis is a stark example of a contraction phase, where global markets experienced significant downturns. Finally, the trough phase is where the market bottoms out. It's the point of maximum pessimism, but also the foundation for the next growth phase. Smart investors often see this as a buying opportunity, anticipating the cycle's shift back to growth. For instance, the period post-2008 saw markets eventually bottoming out, setting the stage for a recovery and the start of a new growth phase. In summary, understanding market cycles and their phases, growth, peak, contraction, and trough, is vital for making strategic investment decisions. Recognizing these patterns enables investors to anticipate potential market shifts and adjust their strategies accordingly. Exciting topics await in our Basic Trading Concepts series. Join us as we deepen your insights into the financial markets. Thank you for watching. Don't forget to subscribe to our channel and hit the bell icon so you never miss an update.